That $2,000 tariff dividend sounds like the ultimate free lunch, but as a tax professional, I don't believe in free lunches. I believe in balance sheets, and the balance sheet for this proposal is hiding a massive red flag. If you are counting on that check to save your year, you are walking into a financial trap. There is a specific invisible tax hidden inside this deal that no politician is talking about. I will show you exactly how this dividend is funded, explain the nightmare tax scenario that could trigger an audit, and most importantly, show you the specific AGI loophole that smart taxpayers will use to keep this money tax-free. Let's explain the mechanics of the tariff dividend. First, we need to understand where this money comes from. The headlines say China will pay us, but I have to tell you that is technically false. China does not write a check to the US Treasury. The importer of record pays the tariff, and that importer is an American company. Let's say an American retailer imports a container of sneakers. If the tariff rises to 20%, that American retailer writes a check to US Customs. Now, that retailer has a choice. They can eat the cost and lower their profits, or they can pass the cost to you, the consumer. If you look at the last 50 years of economic data, the answer is obvious. They pass it to you. The price of sneakers, electronics, and car parts goes up. So the government collects the extra money you spent at the store, processes it, takes a cut for administration, and mails it back to you as a check. In the accounting world, we call this a wash. Money leaves your left pocket at the checkout line, and it enters your right pocket via a government check. But here's where the math breaks down. And it brings us to the deficit problem. We need to look at the scale of this operation. Currently, US tariffs bring in about $80 billion a year, and even with the massive hikes proposed, experts project revenue might hit $300 billion. That sounds like a lot of money, but let's look at the dividends cost. There are roughly 260 million adults in the US, and if you send $2,000 to everyone, that would cost over $500 billion. Do you see the problem? We have $300 billion coming in, we have $500 billion going out, and we are short by $200 billion. This is a classic deficit spending scenario. To fill that gap, the government has to borrow the money or print it. And when you print hundreds of billions of dollars to send out checks, you dilute the dollar's value. We saw this in 2020 and 2021. It triggers inflation. So, mistake number one is assuming this check is profit. It is likely just an offset for the inflation that is about to hit your grocery bill. You might get $2,000, but your cost of living might rise by $3,000, leaving you with a net loss of $1,000. And we haven't even talked about the IRS yet. Well, we will be talking now. The tax trap? Is it income? This is the question my clients are emailing me about. If I get this check, do I have to pay taxes on it? The answer is murky, and that is dangerous. Generally, the IRS operates under the general welfare doctrine, which means payments based on need are not taxable income. This is why the 2020 stimulus checks were tax-free. They were legally structured as an advanced refundable tax credit. However, this proposal is being marketed as a dividend. Words matter in tax law. A dividend implies a share of profits, and dividends are taxable. If Congress miswrites this law, the IRS could treat this money as other income, and you would receive a Form 1099 Miss or 1099-G in the mail. Imagine this scenario. You get the $2,000 in January, spend it on rent and food, and then file your taxes next April. The IRS adds $2,000 to your taxable income, and if you are in the 22% tax bracket, you suddenly owe the IRS $440. But you already spent the money, so now you have a tax bill you didn't plan for. This is a nightmare scenario for unsuspecting taxpayers. And there is another layer to this trap: state taxes. Even if the federal government says the check is tax-free, your state might disagree. We saw this happen recently with state stimulus checks. The IRS said, don't tax it, but states like California and New York have their own tax codes that don't always immediately conform to federal law. Your state could decide that this tariff dividend is taxable income for state purposes. So you might be safe from the IRS, but you could still owe your state franchise tax board. You can always check your state's conformity rules before you spend that money. So, and the cliff danger? Now, let's talk about the most significant risk for middle-class families, the income phase-out. Officials have already hinted that this payment would likely be means-tested, and that means if you make too much money, you get nothing. They might set the cap at $100,000 per family, creating a brutal tax cliff. Let me explain how a cliff works. Imagine your neighbor earns $99,000. He gets the $2,000 check. You earn $101,000, but you get zero. You earned $2,000 more than he did at your job, but because you crossed the line, you lost the $2,000 benefit. Effectively, you worked that extra time for free, but here is the kicker. You still have to pay the tariffs and you still pay higher prices for sneakers and phones. So you pay the invisible tax of inflation, but you don't get the refund check to offset it. High earners effectively subsidize the program for everyone else, and if you are near that income limit, you are in the danger zone. And here's the solution: the AGI Strategy. So how do you protect yourself? If you are in that danger zone, you need to lower your adjusted gross income, or AGI. You need to become a tax strategist. Let's say you earn $105,000. You are $5,000 over the limit, and you are about to lose the check. But before the year ends, you make a strategic move. You contribute $6,000 to a traditional IRA or a 401k. This money comes out of your pay before taxes are calculated, so your taxable income drops from $105,000 to $99,000. Suddenly, you are back under the limit, and you qualify for the full $2,000 check. Plus, you saved money on your income taxes because you lowered your taxable income. You just used the tax code to reclaim a benefit you would have lost. This is how the wealthy operate. They don't just accept their income, they manipulate it using legal deductions. And we need to talk about trade war risk. There is one final risk we need to discuss: retaliation. When the US imposes tariffs, other countries do not just sit there, they fight back. They put tariffs on American exports, and if you work in agriculture, manufacturing, or tech, your job could be at risk. Historically, trade wars have led to market volatility. Suppose you have a 401k or an investment portfolio. In that case, you need to be careful, because while you are celebrating a $2,000 check, your retirement account might drop by 10% due to market instability. That is a loss of tens of thousands of dollars. Do not let the small check distract you from the big picture. And for this, you need to take your action plan. So, what should you do right now? I have 3 steps for you. Step 1. Do not pre-spend the money. I see people making this mistake already. They hear the promise of money and they buy a car. This proposal has to pass Congress, survive the Senate, withstand legal challenges, and have the IRS build the system to send the payments. This could take a year. It might never happen. Do not spend money you do not have. Step 2. Hedge against inflation. If this passes, goods will get more expensive. If you need a new laptop, a new car, or major appliances, buy them now and lock in the price before the tariffs hit the supply chain. Once the tariffs are active, prices will jump overnight. Step 3. Watch your debt. If the government prints money to fund this, interest rates will likely stay high to fight inflation, and credit card debt is financial suicide in this environment. If you receive this check, do not use it for a vacation or a down payment. Use it to pay off high-interest debt immediately. That is a guaranteed 10, 15, or 20% return on your money. And finally, our conclusion. The tariff dividend is a flashy headline designed to make you feel good. But as a tax professional, I see it as a complex financial event with winners and losers. The winners will be the people who use strategy. They will control their AGI, pay down debt, and invest the money. The losers will be the people who treat it as free money and ignore the rising cost of living. Do not be a victim of the invisible tax. This proposal is just the tip of the iceberg. Massive changes are coming to the US tax code over the next 24 months. The 2017 tax cuts are set to expire soon, and tax brackets will shift. If you want to navigate these changes without losing your shirt, you need to stay ahead of the news. I break down these complex IRS updates every single week. I read the thousands of pages of tax code so you don't have to. Click that subscribe button right now, protect your money, And I will see you in the following video.